Thank you for joining us in another episode of the Dealmaker Series. Today, I'm joined by Keith Davidson. He is Dallas market leader for CLA. Keith, thanks for joining us today. Tell us a little bit about yourself and tell us about the firm.
Thanks, James. Great to be here. Like I said, I'm Keith Davidson. I'm the Dallas market leader for CLA. CLA is a global accounting consulting firm, but we are a little different than other firms our size. We focus exclusively on owner-operated companies. So we provide, integrated audit, tax, consulting, wealth advisory, the activities you would typically think of when you think of CPA consulting firm. But our focus and our passion is really on the full life cycle of businesses from owner operated to exit. And I think that's where we differentiate ourselves among our, 8 to 9,000 professionals across 130 offices in the country and around the globe.
Yeah, you guys have quite a footprint, so I know you got a lot of great insights for us. So let's jump right into it. What are you seeing in the current state of deal flow? Is it expanding or is it contracting?
Yeah, I think overall, and I'll talk, a little bit about Dallas, even around the country, it's definitely picked up. I would call it a disciplined recovery and a little bit of a, more steady reacceleration. It's not like some of the, years past we've seen, probably over the last 10 or 15 years, but it's not completely dormant like we saw in 22 or 23 as well. So it's certainly picked up. Interest rates tend to still make it a little bit of a challenge. But from what we're seeing, if you're a quality company with good EBITDA, with good management teams, with strong growth, or at least a fundamental good thesis on what you're trying to do in your market, there's deals there to be had.
Yep, absolutely. That's what I've been gathering myself too. It's a lot of these very disciplined. That's the
Yeah.
word of the day, I think. So what about structures that you're seeing in deals more frequently here in this last quarter or two?
Overall, I think earnouts are still going to be probably one of the biggest, things we see among deals here locally. Earnouts, rollover equity is almost expected now. There's not a lot. Unfortunately, for a lot of business owners we work with, there's not many times where you're just going to get a check and you get to, walk away and go to the beach. You're going to have an earnout, especially if there's any type of difference in valuation expectations. Lenders and other potential investors are also wanting there to be more of a long-term transition and not just a quick exit. I mean, it still happens, really depends on the business, but we still see a lot of earnouts, especially when it comes to founder-led businesses. And I know something we talk to our clients about is, the more you can be independent from the company you founded, the better the valuation is and the better terms you can get on the back end.
What do you think? You kind of touched on that a little bit, but what do you think it is driving that? Is it a difference in valuation or is it risk management?
A little bit of both. It can be risk management because you want to ensure the business you're buying is the business you're going to get to operate or have synergy with. There's also there's differences in valuation. It's like, well, if I'm going to oversimplify for the purpose of our conversation. If valuation's here and you think it's here, well, then they may have a mechanism where you can potentially prove or earn out that valuation over time. I'd say specifically in service-based businesses, we see a lot of that where at some point it is hard to understand the difference between that service business from you and the relationships you've built over time. And so really answer your question. It's a little bit of both from that standpoint.
Yeah. So let's talk about industry and sectors. What industries or sectors are you seeing as most active right now?
Well, for North Texas especially, it's construction, infrastructure, real estate development. We see a lot in healthcare, a lot of dental, physician practices. We see a lot of hospital combinations. Anything when I mentioned service, anything with tech-enabled service. It's we're seeing a lot of those deals as well. And then of course, from thinking of a startup and venture-backed companies, myself personally, I work with a lot of early startup, early technology, companies, and we're seeing, more deals and more investment in those companies as well. In North Texas, I mean, it's so big, it'd be easy just to say all of them, but construction, infrastructure, real estate, healthcare, kind of individually, and then that third one we see a lot of is any tech-enabled service, any SaaS, any really high growth startups, if you will, is what we're seeing the most of right now.
It's interesting you mentioned construction because I happen to know that here in DFW, I think it was something like a third of the 50 fastest growing private
Yeah.
companies that are based here are construction.
Yeah.
And in a couple events I've hosted now, panelists have talked a lot about how the growth here in DFW is bottlenecked pretty much only by infrastructure. And that's some
Yeah.
physical
Yeah.
infrastructure, but also digital. So that's interesting you say that the construction vertical is really active right now. And I mean, I can see that because I drive down the highway and see all the cranes
Right.
everywhere. But
Well, I think to add to that, I think there's also a capability infrastructure gap there as well. And so, yes, to your point, we've been at events. We were at an event last year where it was the 50 fastest growing companies in DFW, and it may as well have been named the 50 fastest construction companies in the area. So that certainly a piece of it with the infrastructure, but even we see it on our side. If you were a founder led construction firm at $2 to $3 million revenue a year, and you have contracts, relationships, and now you're staring at 20, at 50, at 100, you have capability gaps in operations, in accounting, in tax, in legal, and we see those. So we get the opportunity to work with a lot of companies that are going through those growing pains while they're also still having operational growing pains to be able to even get the contracts. Now we work with a group here locally. They've been getting a lot of contracts, but they still have to pay people before they can get paid. Just something that simple of needing the working capital to be able to respond to those contracts. It's all a delicate symphony, if you will. And for the most part, it's gone well. But especially in a place like this, you do see bottlenecks.
yeah, yeah. And just to kind of follow up off of that, because you do see a lot of different industries and such, like you mentioned. What about the around digital infrastructure here? Are you seeing a lot of activity there and
We
a lot of
do. We do see a lot of digital infrastructure. I mean, everything from data centers to how can you make normal processing, faster, cheaper and more efficient. And obviously, AI is a big part of that. And we try to do our own part of AI from a financial systems point of view with clients, but they really need the equivalent in every aspect of it, even operation. You think about construction, you think about scheduling, you think about managing subcontractors. There's a data and digital component to that. Whoever figures that out fast is going to do very well. Because to your point, to the end of the day, you're still managing people, you're still managing manual activities. It doesn't mean you have to manage that manual, but that's where we do see the digital infrastructure is following close behind what we're seeing in the day-to-day business and operation. Certainly a must-have. And I think that you look at the major 5 to 10 metros in the U.S. Dallas is certainly going to go above its weight in that discussion.
Yeah, I agree. I think so too. Um, let's kind of shift here toward economic forces that are impacting deals. What are you seeing around that?
Well, I mentioned it earlier, but interest rates is still probably the biggest one. I mean, what the interest rate comes, I think we're past the point where everyone's wondering if interest rates are just going to miraculously come down. It's still hard to leverage, deal. It still impacts valuations. It still impacts opportunity cost. As well. I mean, even just as looking at a deal and looking at potential synergies makes a big difference. So I think that's probably the single, biggest, headwind from a deal perspective is when you start impacting cost of capital, especially in construction and others where working capital itself is a priority, then you really put a kind of gray cloud over deals in general. One of the things I see really, I mean, it's an economic force, but it's really more the operational side of it. I think we are at a time, and it does remind me of some of the, maybe early, 2010s, is where deals and doing deals is attractive to people, and it should be. It's fun to buy a company, as I was once told a long time ago, earlier in my corporate finance career. It's fun to buy companies. It's fun to do a term sheet. It's fun to do it. It's fun to have the all employee meeting saying we're now working with this, we're now joined with this other company. However, I think with that, people forget why you buy a company. People forget why you exit. And the reason for that, let's say you were just doing an outright acquisition. The reason for that isn't just to add their revenue and EBITDA to yours. If you do that, and that's all you did, the return on that investment's zero. You paid for all that revenue and paid for all that EBITDA. But what kind of synergy can you get out of the two companies? How can you make your customers better by having those two companies, which is in turn going to make your company better? And that goes for whether it's a outright acquisition or if it's a private equity roll up. There still has to be synergy to make the deal worth what you're paying for. And so while it's not a external economic force like interest rates, it's something that I see impact the success of deals once the deal has been made. And I don't know if, people focus enough on that because again, buying the company is fun. Doing the work to integrate it and get synergy from that is not as fun, but that's the part where the deal falls through. That's the part where everyone ends up happy, where they want to do another deal. I think that's one of the drivers that if we don't see it a lot now, I think as deals recover, we start seeing the impact of that over the next couple of years. I think it's something to watch out for if you're looking to make an acquisition or you're looking to exit.
Really good points. Really good points. I I like a lot of that, and yeah, those are things not a lot of owners and buyers think about. I think so. Very very good. All right, so crystal ball time.
My favorite.
Over the yeah, over the next 12 months, 18 months, what do you see coming next for the M&A community?
I think we'll continue to see steady deal activity. I don't know if I could call for a major increase or a major downgrade. I don't see anything that would keep us from being at the pace we're at. I don't think we're going to be back into the early 2010s unless there's a dramatic change in interest rates or some new tax law that's going to make M&A right now more attractive. So I do think we're going to continue seeing, a lot of good deals, steady deals. If I'm a private equity group, if I'm a high net worth individual, or I'm at a company with a war chest per se, I think you get a lot of return of your capital very efficiently investing in North Texas. And I know, people have said that for 20, 30 years here. And I think that's going to continue to be true. I don't know if you're going to get to, seeing, valuations that we've seen before, but I think this is going to continue to be a really great place to invest. I'd say the caution is, for either side of that. If I'm a business owner and I'm looking to exit, we tell our business owners that's a 2 or 3 year process. It's not just as simple as, hey, let's go to put us to market and let's see if we can get sold. There's the operational things you do to get ready. There's the financial. There's the tax side of it. It is a well orchestrated process that unfortunately not all owners do that. But if you really want to set yourself for success as an owner, you need to look into the future. And then I would say on the acquisitive side, whether you're private equity or not, you can't just go shopping and find a company and buy them next month. You need to get to know these companies because a lot of them could be a $5 million service business or a $200 million healthcare organization. You got to know what you're buying. You got to know and understand how to get synergy and how to make both companies and your customers better. Or you really could have just put that money in Amazon stock and you might have been better off. So that's kind of my thought on overall. And if I had a crystal ball.
Yep, we'll see. It sounds like a lot is hinging on interest rates right now for deals. A lot of folks are reiterating that very point. Keith, I love these insights. These are great. I appreciate your time, your insights. For those watching, I hope you find this as useful as I do. Find more episodes of the Dealmaker series. You can follow me on YouTube or on LinkedIn. Keith Davidson. Thank you, sir.
Thanks, James.